Hi everybody, good evening. Okay, I hope you are still feeling okay because it's quite late now. I'm sure you're very tired after a whole day of class, and for some of us, we have to work. I've got 30 minutes, and my objective tonight really is just to share with all of us some practical ways you can really build your investment portfolio, especially an affordable one. I mean, just now you were asking Piyush, he doesn't understand. But he doesn't understand what is affordable, right? I understand what is affordable. So I'm going to share with all of us, okay? I'm going to bring all of us back down to earth. Okay, I'm going to share with all of us how we can go about building an affordable investment portfolio. But we got only 30 minutes. So I'm going to go very fast, and if you have to take all the pictures, please go ahead and take it. I'll try and get out of your way so you can take the pictures, alright? Okay, so let's start. I want to start first by showing you this chart. This is actually a chart of the S&P 500 between 1990 to September 2015. It's as updated as you can get. So it's about 25 years of return of the S&P 500. The average annualized total return of the S&P is about 9%. Total return means that you add the capital gain plus the dividends payout. So that's the annualized average return, S&P. Just notice the chart. Okay, a lot of volatility, up, down, but generally up. Now, second is the FTSE 100. This is the 100 highest market cap stocks in England. Right, so again, 25 years, annualized return, not too good, but now you get an average of about 3.62. You can see a lot more volatile, up, down, but generally up. Okay, this is the DAX, okay, the German stock market. It's a good representation of the European market. Same 25 years, annualized return, average 6.76. Just take a look at the trend of the graph. Okay, you don't have to go into the details. Okay, it goes up, it goes down, plenty of volatility, generally upwards. Okay, and next, okay, this is the Hang Seng. Okay, this is Asia, 25 years, same time period, average return about 8%, total return. Okay, again, plenty of volatility. You can see a lot over here. This is 2008. Yeah, generally up as well. So this is 25 years return. Okay, and ended September, okay, just last month. I'm going to just let you take a look at 100 years return, okay, and that is just the US market. This is a study done by Credit Suisse, one of the bigger banks in the world, and they did a study on 17 stock market, 17, but this 17 stock market actually constitute about 90% of the world's market, meaning to say they focus on the big markets. Okay, and I'm just showing you the US market. Ignore the bottom three, just take a look at the top one, which this is the total return again. Okay, volatile. But there are a few things that we can notice from the past 100 years. And that is, in the past 100 years, there were three major crises. Okay, the first one happened, okay, the box should shape a little bit, but it happens between somewhere in 1928, you can see 1928, all the way down, you see the big crash over here before it recovers. Never really recover, but recovers at least. Okay, so this one, many of us know it to be the Great Depression. This is the worst time in the market for the past 100 years. Now, interestingly, if you add 40 years, so you take 40 and you add 1930, you get a second big one between 1970 to 1980. You see another crash there. Yeah, this is the oil crisis. Okay, a big one. You see a big crash over here. Okay, and interestingly, if you add another 40 years to 1970, what do you get? Simple math. 1970 plus 40, what do you get? Not so difficult. 2010. Right? But we got it slightly earlier. We all know that in 2008, I'm sure we know, especially if you're a finance student, I'm sure you studied, we had a very big recession or a big crisis, right? The great financial crisis that started from US and then it came and it affected all over the world. And that was in 2008, specifically September 2008. Now, so what am I trying to say? Now, of course, I'm not saying that the next crisis is going to happen 40 years later. You can all go home. The next one is 2050. Okay? Now, that's not what I'm saying. But if you look at the markets for the last, there's a small crisis and all that. If I've got the time, I'll talk about what's the difference between a big one and a small one. But generally speaking, the major crises are those that it affects the whole world globally. It's a structural breakdown. It affects the whole world, and it takes a long time to recover. It is not the small ones, the business cycle ones. You know, it goes up, it goes down. That's fine. When we go through that, and we have one Asian financial crisis with a tech bubble burst. We're not too worried about those, but we are really worried about these very big ones. So if we look at the charts, all the charts that I've shown you, okay, over the last 3 minutes or so, we can actually learn 3 lessons, make 2 applications, and have 1 observation. Easy, right? 3, 2, 1. 3 lessons, 2 applications, and 1 observation. So let's start the first one, 3 lessons. Now, what are the 3 lessons from history? Now, history may not always predict the future, but history is a good teacher. So the 3 lessons that we can learn from history. Number 1, a major crisis doesn't happen every now and then. It happens every few decades. And I hope that is good news. Yeah, because, I mean, life is like that. I mean, most of the time, it's good, right? No, life in SMU sucks. Every day it sucks. No, right? I mean, most of the time it's good, right? And some days it's bad, you know, and life is like that. It's the stock market as well. Most of the time it's fine. Okay, and a major crisis doesn't happen every few years. I mean, it happens every few decades. This is the first lesson we learn. And the second lesson is, no matter how bad a crisis, we always recover. We recover from the 1928 crisis, we recover from the mid-1970 crisis. I mean, the way we have recovered from the 2008 crisis. So no matter how bad a crisis, it always recovers. Now, the third thing that we can learn from the stock market is, generally over the long term, the good news is the stock market goes up. So 3 important lessons that history has taught us. First one, a major crisis happens every few decades, so I hope you don't get too worried about it. Okay. Secondly, no matter how bad a crisis, it recovers. And thirdly, the market generally goes up over the long run. So keep these 3 lessons at the back of your mind, because it is going to help you make your investment decision. 3 lessons, 2 ways to invest. So these are 2 applications. So now that you understand the market goes up, goes down, goes up, goes down, which I've been showing you for the last 5 minutes or so, now you know that there are 2 ways to invest. Actually, there are many ways. I'm just going to talk on the 2 main ways to invest. The first way to invest your money is you time the market. What is timing the market? Timing the market is really simple. Okay, just look at the chart here. Timing the market is all about buying here, selling here, buying here, selling here, buy, sell, buy, sell, buy, sell, buy, sell, buy, wait, sell, buy, sell. That's timing the market. And if you get it right all the time, then you boom down Charlie. You understand? You understand boom down Charlie? You understand what is boom down Charlie? Okay, boom down Charlie means you make a lot of money. Okay, so if you can always get in here, get in, get out, get in, get out, get in, get out, then you get it right all the time, you're going to make lots and lots of money. But the problem is it easy to get it right all the time? Is it easy to get it right most of the time? In fact, it's very difficult. I mean, if you imagine a stock market to be just a 2% stock market, just 2% of the stock market, if I think this is the best time to buy here, someone must think that it is the worst time, right? And so they better sell it to me. Because if nobody's going to sell it to me, I'm not going to be able to buy anything. Isn't it true? And so if I think that this is the best time to buy, somebody must be thinking this is the best time to sell. And someone is going to be wrong 50% of the time. So it's not easy to be right most of the time. I mean, otherwise, people will pay huge amount of money to analysts, to think when is a good time, to understand where the market is going. But there are people who actually believe that there are people out there who really know exactly where the market is going. How do I know? Because a lot of times when I go for talks like this, and all that, and they will ask me, is this the best time to go into? I mean, just now you all asked this question, right? You ask whether this is the best time to go into property. People always ask this question, right? And okay, I don't know about other people, but I'll tell you, I don't know. I actually don't know. Because if I know, I wouldn't be telling you. Because if I tell you you go in, then you share my return, then I won't get so huge a return. Right? So, but there are people who believe that there are people out there who actually know. So if you still believe that you can time the market, I mean, there are people who can do it successfully most of the time, great, okay, but it's hard, okay, I can't do it. But if you still think that you can easily do and beat the market, then consider this. Okay, this is a study done by this guy called Michael Matheson. He used to be the chief investment strategist of one of the big fund house called Lake Mason. And he actually did this study and he published it in the Financial Analyst Journal. Okay, and he studied the S&P 500 return between 1978 to March 2007. He found that the average return during this period was about 9.5%. That's the average. And if you are able to take away the worst 50 days, that means each time before the market dropped, you already got out of the market. You are so good, okay, and you are able to siam on the worst 50 days, then your return will jump to 18.2%. Pretty good, double digit. But unfortunately, if whilst you are trying to get out from the market, you are trying to sell the market, actually you are wrong. Means the market actually goes up. So you miss the best 50 days, then the return actually dropped to 1%. Quite jialat. So this is what he found out. And by the way, he's an active manager. Okay. Now, the second study. Now, this is one of my favorite author. I love his book. So some of you ask for a book to read. I recommend you this book to read. Okay, besides Benjamin Graham. Okay, Benjamin Graham. It's a good book to read, but not easy to read. It's a very technical book. He wrote a book called Security Analysis. Tough book. Okay, but please read it. I recommend you another book called A Random Walk Down Wall Street by this guy called Burton Malkiel. He's a professor at Princeton University. He used to advise the president of US, and he did a study over the past 54 years. He found that the markets has risen 36 years, even 3 years, down only for 15 years. So in short, most of the time, and I hope again that's good news to all of us, most of the time, people good mood, market also good mood, most of the time it is up. Okay? Now, if you conclude from these two studies, the conclusion that we can draw is, if you try to time the market, if you are wrong, you are very jialat, right? You are in a very bad shape. And what are the chances of you being wrong is 3-1 against you, because most of the time the market is either flat or okay. It's not easy to try and get out of the market when it's bad. Even if you can get out, the question always is, when do you get in? I don't have a lot of time, but I just wanted to share this story. Now, at the peak of the crisis in 2008, I had this investor that was with me. He's a pretty huge investor, and the market actually came down. Okay, and we were asking him, please stay there, please stay there. But somewhere in March of 2009, he came back and he said, he's about then late 50 years old, and he came and he said, Chris, I can't take it anymore. I can't take it. The markets are just going down. I do not know. I mean, if you live through 2008, 2009, and you are invested, you are really scared, because everything that comes out from the papers are just bad news, bad news, bad news. Really no light. Okay, and we don't know where the markets are heading. It's really very scary. We were managing a small portfolio of about, I mean, by the fund management standard is small, we were managing a portfolio of about 254 million at the peak. Okay? And in December of 2008, from 254 million, redemptions plus when people get out of the market and the market value drop, it came down to as low as about 180 million. Okay? And it was really scary. And so this guy came in March and he was really worried. And he said, I think the market is going nowhere. I think it's going to go down further. I want to get out. And despite us trying to tell him, don't get out, don't get out, don't get out, he got out in March of 2009. What happened after that? The market recovered. And then when the market recovers, it's no fun. When the market recovered, he called us and he convinced himself that the market is going to, this is fake. The market is still going to fall somehow. He told himself, no, I'm not going to go in because it's going to fall, it's going to fall, it's going to fall. This is bluff and all that. But the market kept going up. Sometimes you can, you may get out at the right time, but going back at the right time, it's a problem. Alright, so that's the problem with market timing. It is not that you can't do it, but not many people can do it well. And what makes us think that we are better than all those professional investors out there, that we can beat them? It's not easy. I'm not suggesting you don't do it, but I'm telling you it's very tough. It's one way of investing. Okay? And it's a very stressful way of investing, because half the time you're trying to guess whether the market is going to go up, go down, go up, go down. And you really don't have to do that. So I'm going to suggest to you the second way of investing, and that is keep investing, stay invested. Now, what is this method of investing? Now, in this method of investing, don't expect to get the best return from the market. Yeah, because you're not trying to get in the best time, get out the best time. What you are really trying to do is you're just trying to get the average return of the market. So if you look at the first four charts that I showed you earlier, and I gave you the average return, some were like 3%, the highest was I think the S&P 500 at 9%. So if you stay invested throughout at 25 years in the S&P 500, you would have gotten an average of about 9% total return. You're not going to get the best return, you're just going to get the average return. You stay there, you don't get out, you don't jump in, you don't jump out, okay, at the wrong time, or you don't keep on jumping in and out. It's less stressful because you don't have to guess when's the best time to get in and get out. But however, in order to do this kind of investing, you have got to meet three conditions. Condition number one, you must have time. Okay, at least I would say 10 years. Because if you don't have time and you want to invest for 3 months, 6 months, 2 years, then you really got to speculate. You understand me? If you don't have time and you need to get out of the market in the next 3 months, 6 months, 1 year, 2 years, you really have to speculate. You have to find the right time to go in and the right time to get out. However, if you have time, and I'm looking around this entire auditorium, most of us have time. You have plenty of time, right? You have plenty of time. Actually, you have more than 10 years. Okay? You meet condition number 1. Condition number 2, you cannot buy one stock. Because if you buy that one stock and the company goes down, it's the end. No point, stay invested, keep investing. The guy is dead. Right? You can kick and you say, okay, I'm going to stay invested. But that guy, the company is not there anymore. So you cannot buy one stock. You all understand that. Okay? In fact, if you can, buy the entire market. Buy the entire S&P 500. Then you are very well diversified. Okay? And don't buy one market. You invest in different markets. So 3 simple conditions. You must have time. Don't buy one, buy the entire market if you can, and invest in different markets. So far, are we okay? Now you understand this, right? Why? Because it is based on that 3 lessons that we learned from history. A major crisis doesn't happen every few years, it happens every few decades. No matter how bad a crisis, it recovers anyway, and generally the market goes up. So if you know that generally the market goes up, then all you need to do, invest in different markets, diversify portfolio of different stocks, stay there, stay invested, you get the average return of the market. Simple? Simple. End of class, you can go home. All you need to do is just to execute this strategy. Unfortunately, one observation, the head and the heart cannot connect. Because the head understands this, but the heart cannot understand. Do you understand? What I mean is this, you understand, yeah, I'm going to stay invested, okay, I'm invested, I'm able to stay invested. The head understands it. But when the market starts to collapse, you are listening to your heart. When you read the news, your heart is telling you better zao. Everybody run, cannot be they wrong, right? Majority wins, I better also run. So the heart will tell the head, you are wrong. The head and the heart cannot connect. And most of the time, who do you think makes the decision? Do you think it's the head or the heart? What do you think? It is always the heart. That's why marriages happen. Except for Mr. Gerald, he makes the correct head and heart decision. Okay, no, but what if, if you really truly ask ourselves, actually the heart makes the decision. Otherwise, how do you explain for so many of the wrong things that are happening around the world? Many of these wrong things, when you look at it, I mean, in your head, you are thinking, how can they do this kind of thing? How can murder happen? How the head understand? We all understand what is morally wrong, right? But the heart can't take it and we do it. Most of the time, the heart is the one that makes the wrong decision. So the next time, when your friend comes to you and they ask you for some advice, please don't follow what the movie teaches us. You see those movies, right? The friend will talk to another friend and say, you know, this decision to make, you know, what should I do? And then the beautiful music will be played, and then the friend will tell the other friend, follow your heart. I mean, you're so inspired, no? That's the thing, always follow your heart. Now, if you always follow your heart, I mean, there's a danger of making a wrong decision. I've been married for 20 years. My wife gave birth to 2 kids. My kids are all grown up already. My son is 17 and my daughter is 13. So after giving birth to 2 kids, she's now fat and ugly. Just kidding, I'm just kidding. Okay, assuming she's fat and ugly. So here I am, you know, I'm in SMU, I see all the beautiful young ladies, and I said, oh, you all look so beautiful. Now I'm torn because I don't like my fat wife anymore. So I go and ask my friend, what should I do? Should I divorce my wife and marry this new girl? And my friend said, follow your heart. And that's correct, yeah, I want to do that. So I'll just divorce my wife and then marry a young girl. I mean, you know that that's wrong, right? So we cannot just make decisions from the heart. The heart, I'm also not asking us to make decisions from the head without the heart. We should make heart decision, but tempered with the head knowledge. You make a heart decision, but you got to check your head to say whether that is wrong or not. Okay? So, what I'm trying to say is that you need to align your head and your heart. But how do you align your head and your heart? I'm going to give one last illustration, then I'm going to move on, okay? Now, we all know that the roller coaster is safe, right? Some of you go to Universal Studios and you go and take that, what's the roller coaster called? Battlestar Galactica, right? You know it's safe. It's safe. Okay? But why don't you take it? For some of us who we don't take roller coaster, because you know your heart can't take it. Even though you know it's going to be very safe, 3 minutes later it's going to end, you are going to be safe. But the fear is that because your heart can't take it, halfway through you may just die of heart attack. Or if there's a stop button, you probably press, you'll drop down. It's not that the head doesn't know it's safe, but the heart can't take it. And for you to really enjoy that roller coaster ride, you need to find a roller coaster that in your head you know it is safe, but you look at it and you tell yourself, my heart can take it. I'm probably going to enjoy this roller coaster ride. It's going to be a bit thrilling, a bit exciting, but yet you're going to finish the ride. And that is, this is the same approach you take to investing. So how do you align that? Okay, so step number one is you need to know your risk appetite. I know we all hear that already, but how do you really identify your risk appetite? How do you decide? Because the goal is this. The goal is once you are invested, you need to stay invested and ride through. That's the goal. Because why? You know the 3 lessons from history, right? Generally the market goes up, no matter how bad the crisis, you always recover. A big crisis doesn't happen every year, it happens every few decades. So you know based on history, all you do, diversify across markets, diversify across stocks, and you invest and you stay there. The whole objective is you don't get out at the wrong time. But your head and the heart must be able to take it. So to be able to align that, first thing, please know your need to take risks. Your need to take risks is based on your need for returns. Today, if you only want 2% return per year, you don't have to take risks. Just buy the Singapore savings bond. You no need to take risks. The only risk you take is the Singapore government collapse, right? But will the Singapore government collapse? Never. It's SG50. Okay? So, if you need 2% return, then you have to take risks. But if you want 8% return per year, then your need to take risk goes up. Does it make sense? So you're going to first determine what is that need to take risk by knowing what is the return you're looking for. Secondly, ability to take risk. Because you may need to take risks, but you don't have the ability to take risks. Now, what determines your ability to take risks? Many things. Okay, the younger you are, the higher the ability to take risks. The more time you have, the higher the ability to take risks. The stronger your financial health, you don't over borrow, you don't do high debt, you have stable income, the higher the ability to take risks. Physically, if you are healthy, higher ability to take risks. If your insurance all that, you have a higher ability to take risks because you have to get out of the market to get the money out and pay for medical expense. If you are single, many of you are single, higher ability to take risks. If you are married, lower ability to take risks. If you've got 2 kids, even lower ability to take risks. If you've got 10 kids, you've got 0 ability to take risks. Liquidity. If you have no liquidity needs, then high ability to take risks. But if you've got high liquidity needs, then you have a lower ability to take risks. Investment amount, if you're investing $1,000, your ability to take risks is very high. If you're investing $100,000, then your ability to take risks may drop. All these things affect your ability to take risks, and you can go and check yourself. Go back home tonight, ask yourself. Most of us here, if you are students here, most of us here, your ability to take risks is pretty high. Okay? Now, willingness to, unless you are engaged with your girlfriend, then your ability to take risks is lower. No, I was just kidding. Okay, willingness to take risks. Now, actually, in the industry, we do this thing called risk profiling. But even you don't have to answer all these risk profiling questions or that, you can ask yourself, am I willing or not? Am I willing to ride that roller coaster ride or not? Now, so, let me try and put these 3 things together, because these 3 things put together will determine the kind of roller coaster you should ride on. So say for example, today, you have no need to take risks, and you also cannot take risks, but you are very willing to take risks. Should you or should you not? You don't need, you cannot, but you want. Should you? No need. I mean, cannot. Even if you want, you should not, right? I mean, it's like you don't need to take drugs, you cannot take drugs. But you say, well, I got free, I want to take drugs. Should you? You shouldn't, right? Or simply understand, right? So you're going to ask yourself these 3 questions. Okay, so let's take it to the other extreme. Today, you need to take risks because you need the returns, and you can take risks. But you say, I'm scared, I don't want. Now you need and you can, but you don't want. Should you or not? You need. Tomorrow exam, you need to study. You can study for exam, but you go back and say, no feeling. Should you study for exam? Yes, you should, unless you're prepared to bear the consequence, which is to fail the exams. Yeah? So if you don't want, then you have to accept a lower return. Alright, so you understand how to make use of these 3 things? Yes or no? Yeah. Okay, good, because I'm left with like 0 minutes. Okay, and I've got quite a lot of slides to cover. Okay, but so you understand, this determines the kind of roller coaster. So let's assume that today, all of us here need to take risks, can take risks, and want to. That's why you're here for this conference, right? Because you want to take risks. So you need, you can, you want, so you should. So you should take risks. So the step number 2 is now you build a roller coaster. Okay? Now, just before we build a roller coaster, I just want to say a word on savings. Okay? Now, there are 4 ways to become rich. What are 4 ways to become rich? First way, born rich. How many of you here born rich? Okay, don't have. That's second way. Second way, marry rich. Many of you here are still single. If your girlfriend, boyfriend not rich, sack him or her. Because you just lose your second chance to become rich. What's the third way to become rich? You're born with the right sense of timing. Whatever you buy, make money. Lucky draw, nobody win, but you win. If you don't belong to this 3 category, then you are left with the last category. That is, in a systematic and organized way, you first save and invest, then invest to become rich. Now, I just want to emphasize this point. If you cannot save, you should not invest. Savings always come first. Why? Because savings increases your ability to take risk. When you have savings, like what Mr. Piyush mentioned earlier, you are able to hold. Okay? So save before you invest, have at least 3 to 6 months of liquidity to increase your ability to take risk. 3 to 6 months, meaning to say, especially when you go out and work. Okay? Have 3 to 6 months of your expenses in cash, so that you know for any reason you lose your source of income, you are able to tahan for the next 3 to 6 months. You don't have to sell your stocks and get out of the stock market to fund your lifestyle. Alright? And have a budget to pay yourself first. What is a budget? First, you estimate your income. Second, please don't minus expenses. Then whatever left, then you save. That's not budgeting. Because otherwise, like that, you may not save anything. Okay, so step number 1 is you estimate your income. Number 2 is you target the saving amount that you really want to save. Then after that, you go and adjust your expenses so that you are able to meet the budget. Are we okay? This is important, but I have no time to elaborate on this. I mean, if I try to give you a simple budgeting technique to do it, but no time. Okay? But I just want to emphasize, you need to save first before you invest. Okay? Savings increase your ability to invest. So once you are done with that, you are ready to build your portfolio. Okay, I'm almost done. Okay, so let's say you need to take risks, you can take risks and you want to take risks, therefore you should take risks. You are a very aggressive investor, let's say. So if you are an aggressive investor, this is a sample. You know what sample, right? Sample means please don't take picture, copy exactly, go and buy. It is sample. Okay, this is how an aggressive portfolio might look like. You can see most of your monies are actually into equities. Okay, so you have only 20% in bonds, 80% equities. The bonds are really there just to moderate the volatility so that you can tahan and sit still and don't jump at a wrong time. Because remember, the objective is to sit still, don't get at a wrong time, right? The bond, 20% bond is just there to moderate the volatility so that you are able to sit still. The rest of the monies are actually into equities. So you have 40% global equities, 30% Singapore equities, 10% in emerging market equities, because EM is actually, emerging markets is actually the riskier of the whole lot here. Right, so this is a sample of it. So once you decide that this is your allocation, okay, you are ready now to go and buy the nuts and bolts, the screws and all that, to go and invest it, execute. So let's say you are doing this, 20% bonds, 40% global, 20% Sing equities, 10% emerging markets. Okay, you can execute it. The cheapest way to execute it is to buy an ETF, an exchange traded fund, because with one ETF, you are basically buying the entire stock market. It's an affordable way. Okay, so these are some examples of some of the ETFs. They are not exhaustive. Okay, please go and research a little bit more, but you can take a picture. These are some of the ETFs that are available. Okay, the good thing about ETF is low cost. Okay, and you're exposed to the entire market. Now, I just want to quickly say a little bit about ETFs. No time again, but please research a little bit. Understand that there is a difference between physical and synthetic or derivative-based ETF. Okay, physical replication means that ETF is, if I explain it very simply, and it is not 100% accurate, the people who are in investments will probably cringe and be very angry with me, but imagine that an ETF is a company listed on the stock market. You are investing into this company. So if this company owns 500 stocks, basically you are a shareholder of these 500 stocks, right? So a physical replication kind of ETF is you are buying an ETF that actually go and buy the 500 stocks. That's physical. Okay, it's in a way safer in a way. Okay, synthetic-based ETF, they may not hold 100% the actual stocks. Okay, they use derivatives to go and buy. And I don't have time to go and draw a diagram to show how a synthetic-based ETF works. But synthetic ETFs has got higher counterparty risk because you are using derivatives. Okay, so please go do a bit of research between physical and derivatives. Quite a bit of our ETFs on the SGX, they are synthetic ETFs. Okay, fees. Okay, the two other things you have to consider is fees and tracking error. Fees, you know, I know the cheaper the better. Is it always true? Not always true. Huh? Okay, so let me give you an example. Okay, so this is the Nikko STI. The fees, annual fee is 0.245. This is the Spider, okay, which is 0.3. So you see this is slightly more expensive than this. However, the tracking error of Spider is better. Okay, because it means there are lesser error tracking the Straits Times Index. They follow very closely. This one has got higher error. And if you look at the both of them, for that higher fee, I would likely choose Spider because the tracking error is lower. It follows closer to the Straits Times Index. Okay, so far? So these are some of the consideration. Okay, again, please read up. Okay, or you can go to the Money Sense website, or you can go to the CS website. We have given past talks on ETFs. You can watch the video, okay, to understand a little bit more. Okay, this one, let's take a picture. Because I have no time to talk. They ask me to tell you where to buy, how to open an account, how cheap, what's the minimum. Okay, it's all here. Do you want me in the picture? No, okay, so just take a picture. It's quite self-explanatory. You're all smart people. Okay, so basically this column is what the asset class, what is it for, where to buy from, what to do, expenses, how much it costs, minimum amount, you know, and all that. So it gives you a feel. And whatever I'm telling you here, they are affordable. Okay, meaning to say, I think about $5,000, you can actually start a portfolio like that, thereabout. Okay, one last thing before I go. There's this whole concept of regular savings, right? So every month you put in, you put in. ETF is not a good idea if you want to do that. Okay, especially you're putting in a small amount. Because buying an ETF is like buying a stock, there's brokerage. And you know there is a minimum cost to brokerage. I think it's like $25, I don't know. Right? So if you are putting like, you want to put like $500 every month, it is actually a very expensive way to buy ETF. Alright? So rather than just every month you put in $500, you may want to save up until maybe $5,000, $6,000, then you buy. Alright? Otherwise it's a very costly way to try and invest in ETF. Sorry, I've tried my best to speak as fast as I can. I hope in some ways you have got an idea how to start an affordable investment portfolio. Thank you very much.